We had some mic issues over the weekend, couldn't sort it in time, so the audio's a bit rough. Sorry about that. Hey, welcome back to Three Clowns, episode 16, Monday, April 27th. So Intel and Meta just threw fresh money at the AI trade right as we're heading into FOMC week, with the Strait of Hormuz still locked down, and the real question today is whether the AI bid can just run through everything else.
Yesterday, I spent 10 minutes trying to open a child-proof cap, which is a weird way to find out the child is smarter than you.
Oh, man. Those things are basically an IQ floor for parents. And we're both definitely under it.
So here's what we're working with this week. Friday was basically a clean trade. The AI names just ripped. AMD up nearly 14%. NVDA up 4.3%, the Nasdaq up 1.9% for the day. And the catalyst was simple enough. Intel threw up earnings Thursday night that people actually believed, and Meta said they're cutting 10% of their workforce to basically go all in on AI infrastructure. That's not restructuring noise. That's a company saying we're spending real money on this thing, and the market paid up. But here's the thing that matters. That money came from somewhere. Financials slipped Friday. Industrials lagged. Small caps got left in the dirt. So you had this incredibly narrow leadership where the mega cap AI stocks got bid and everything else had to get sold to fund it. That's not the same as a broad risk-on day. Now throw in what's actually happening this week. The Strait of Hormuz is still locked down. We're 3 months into that now, and Brent crude popped back above 107 over the weekend after Iran talks basically stalled out. That's usually the kind of thing that makes markets nervous about growth and inflation at the same time. And then you've got the FOMC Wednesday. That's Powell's last meeting as chair, which means everyone in the market is about to have a very strong opinion about where rates are actually going and whether an AI-driven rally built on narrow tech dominance can actually keep running when the Fed is sitting right across the table from you. So the central question we're chasing today is pretty clean. The AI trade just got fresh fuel, but rates are going to have something to say about that this week, and we need to figure out which one blinks first.
The market's treating AI capex like it exists outside the economy. It doesn't. That spend gets funded with the same dollars that just got more expensive because oil's at 107 and the Fed hasn't cut yet. You can't have infinite GPU demand and also pretend the cost of money is a hobby.
Tom, the cost of money as a hobby is going on my whiteboard. But you're hitting the nail on the head because that Hormuz bottleneck is basically a giant unvoted tax on the entire global supply chain. If oil staying at 107 forces the Fed to keep rates pinned high on Wednesday to fight energy-driven inflation, then all this AI capex stops being innovation and starts being a very expensive debt load that the market hasn't actually priced in yet.
Yeah, you two just nailed it. So the setup is real. AI spending is cheap only if rates stay low, and oil at 107 is basically a silent veto on that happening. Let's get into the tape and see what Friday's actually telling us about which side of that trade the market's actually believing right now. So Friday was basically a masterclass in how to gap up the entire semiconductor stack on the back of two pieces of news that landed after hours Thursday. Intel reported earnings that beat expectations, and then they guided data center revenue higher, which is not something you see from Intel very often. And Meta announced they're cutting 10% of headcount, but explicitly tying it to this AI infrastructure push, right? So the market opened Friday morning and just said, okay, the AI capex cycle is real, it's accelerating, and semis are the play. AMD ripped nearly 14% on that sympathy, NVIDIA up 4.3%, and you had QQQ up almost 2%. But here's what's interesting, and this is the thing that gets at the real character of Friday. The Russell lagged the Nasdaq by more than a full 0.5%. Cyclicals sold off, healthcare sold off. This wasn't a risk-on day in the traditional sense where you're rotating out of defensives into the broad market. This was money moving specifically into the mega-cap AI train, full stop. Tom, I want to ask you straight up, is the AMD move Friday a genuine repricing of semiconductor demand for this AI cycle, or are we looking at a one-day sympathy pop that could easily reverse Monday?
It's a repricing of how much people are willing to pay if nothing goes wrong. 14% on sympathy means you're not underwriting AMD, you're underwriting the entire AI capex chain staying perfect while the 10-year behaves. Which is a lovely story, until rates move 20 basis points and the math stops working.
Exactly, Tom. And you really see it in that massive Russell Nasdaq gap from Friday. When cyclicals and healthcare sell off while the chips rip, that's the market admitting the soft landing is a fairy tale for everyone except the hyperscalers. It's capital huddling together in the only room where the heating still works because those AI budgets are insulated from the Fed sledgehammer, while the rest of the economy is still smelling smoke in the basement.
So what Tom and Ray are saying is that Friday wasn't a broad risk on rotation. It was capital, fleeing everything that depends on a functioning economy and piling into the one sector where the money flow is actually guaranteed because it's coming from balance sheets, not from consumer spending or credit creation. The Intel guide, the meta commitment, that all landed after hours and the market woke up Friday morning and said, okay, this thing is real and it's ring-fenced from the rate cycle. Now look at pre-market this morning. AMD holding the bid at plus 1.4, NVDA barely moving, but Apple down $1.19. That's the tell. Apple is the proxy for broad consumer tech, and it's getting absolutely left behind, which means the market isn't buying a synchronized bull case here. It's making a bet on AI capex intensity while hedging macro deterioration everywhere else. The real question is whether this tape holds when we get into FOMC week, because right now it's pricing in a world where the Fed stays patient while corporations just keep throwing cash at chips. Ray, what are you seeing in the macro setup that either supports or breaks that thesis?
Alex, it's that USO dip on Friday that really gets me. Because it was such a classic head fake. People saw the dollar move and thought the oil trade was cooling. But Brent popped right back over 107 over the weekend because the physical reality hasn't budged. We're looking at the third month of the Strait of Hormuz being effectively closed. And with those US-Iran talks stalling out, that's not just a supply constraint. It's the oxygen hitting that smoldering inflation basement I keep talking about, and it's going to make that PPI print tomorrow look very uncomfortable. Now, look at the financials. The XLF was down on Friday even with Warsh sounding hawkish, which usually sends bank stocks higher on the promise of better margins. But the fact they faded tells you the market is smelling something else entirely. We've got Gulf states practically begging for dollar swap lines, and Besant is out there defending them. That means the plumbing is under real pressure, and global dollar liquidity is tightening up in a way that makes a Fed rate cut almost impossible, even if the economy starts to wobble, because you can't ease into a liquidity squeeze without blowing the roof off inflation. It's like the Fed is trying to use a sledgehammer to fix a Swiss watch while the floorboards are actively catching fire. Tom, when you look at that dollar funding stress in the Gulf, do you think the market is actually pricing in a systemic liquidity crunch before we even get to the Fed on Wednesday?
No, it's pricing a rate story because that's the only language it speaks at 4 a.m. The swap line stuff is plumbing, and plumbing only matters to the market when something backs up into the living room. Right now, it still thinks this is a higher for longer conversation, not a dollars are quietly disappearing offshore problem.
That's the real meat of it, isn't it? Tom's saying the market is still operating in a language the Fed speaks, but the actual problem is happening in a different language entirely. Ray, so you've got oil at 107 heading into Wednesday, and the Fed's got to write a statement that doesn't either pour kerosene on the energy trade or accidentally admit inflation's got legs again. How do they actually thread that needle?
You know, yesterday I was looking at the Fred chart for the personal saving rate again, and it looks like a heart rate monitor for someone who's been dead for 20 minutes. And yet we expect the Fed to have surgical precision here? Alex, they aren't threading any needles on Wednesday. When oil is at 107 because of geopolitical plumbing and swap line stress, the Fed's interest rate tool is just a sledgehammer trying to fix a watch. So they'll go deliberately vague and lean on data dependency to avoid committing to a massive policy error. The real tell won't be the statement. It'll be how Powell handles the press conference when someone asks if they've actually lost control of the energy component. Tom, let's shift gears. What are we looking at for the earnings setup this week?
Yeah, so the setup is basically Intel and Meta told you the story on Thursday. Demand is real, spend is going up, margins are a suggestion. And then AMD gaps 14% on sympathy, which is the market saying we've decided how this ends already, which is always when it goes well. The problem is, you've now got all four hyperscalers reporting into that. Microsoft, Google, Amazon, Meta, in the same week as the Fed. So you've stacked the most crowded trade on top of the one variable that actually prices it. If the 10-year drifts through 4.45, that 35x multiple stops being a story about growth and becomes a math problem you fail in public. Doors are normal size. The crowd is not. And the nuclear PPAs. That's them trying to take energy out of the equation entirely. Like, fine, we'll just own the denominator. But if oil's at 107 and rates back up, the market doesn't care that your electrons are prepaid. It cares what discount rate it's using on your cash flows. So this week isn't, did they beat? They will. It's, did they beat enough to justify the multiple while Powell is potentially repricing the multiple? Alex, what do you think breaks first if something slips? Is it margins or CapEx guidance?
I think CapEx guidance breaks first, honestly. Margins compress and everyone nods along. Oh, they're investing in the future, that's the story. But if one of these guys pulls back on CapEx or even just signals that the growth trajectory is flattening out, that's the company itself saying the AI thesis has limits, and that narrative doesn't recover this quarter. The other thing that's brutal is the timing. You've got four hyperscalers reporting plus the FOMC all crammed into the same week, so there's nowhere to hide if this cracks. One bad number and the whole momentum reverses before anyone can spin it.
You're spot on, Alex. But the macro layer here is that while these guys have hedged their energy costs with those power agreements, they can't hedge the Fed. These massive AI buildouts were modeled and funded when borrowing was basically free and at a 4.5% 10-year yield. That CapEx guidance becomes a debt servicing conversation they haven't had to have in a decade. Tom, does that reality hit the tape today, or are we waiting for the actual prince to break the spell?
Not today. Today you still have narrative dominance. Intel and Meta said demand is real. AMD did the victory lap, and nobody wants to be the first person to say maybe the math changed while price is going up. This thing runs on belief until it physically can't. And the break is mechanical, not emotional. It's either the first hyperscaler blinking on CapEx, actually cutting or even just flattening it, or the 10-year walking through 4.45 and forcing everyone to rerun the spreadsheet at a higher discount rate. One of those two happens, and suddenly investing for growth becomes, oh, we borrowed at zero and it's not zero anymore. Doors are normal size again, people just notice. So yeah, not today. The spell holds until something observable breaks it. Alex, kick us into calls.
Alright, so Tom came through yesterday with NVIDIA at 208. I was right on the QQQs, and Ray is now 0 for 10. That's a perfect season, just not the kind we celebrate. Anyway, we've got earnings landing this week, the Fed on Wednesday, so let's see if we can't shake some things loose. Tom, you're up. What's the call?
Yeah, everything's kind of waiting for Wednesday, pretending it isn't. Oil at 107 is the bit people are politely ignoring, which is nice, until it isn't. The QQQs close red, down about 0.75%. I'm wrong if the 10-year drops back under 4.25 and just gives tech permission to levitate anyway.
Tom, you're looking at the same scary oil numbers I am. Brent at 107 isn't just a commodity move. It's a giant neon sign telling the Fed they can't even think about softening the tone. So a red day for the tech stocks makes total sense when the cost of capital is looking at a floor that just won't stop rising. Yesterday, I was staring at the Fed chart for 5-year break-even inflation rates, and it's like the market is trying to whistle past a graveyard. But the graveyard is on fire. The 10-year finishes the day above 4.35%. We're at 4.31 right now, and as the realization sinks in that energy costs are going to keep the inflation data hot, traders are going to start front-running a hawkish Powell before he even opens his mouth on Wednesday. I'm wrong if that Dallas Fed data this morning comes in absolutely abysmal. If the manufacturing sector looks like it's actually cratering, the yield will dive on a flight to safety regardless of what oil is doing. And yes, Alex, I know, 0 for 10. Honestly, being this consistently wrong for this long takes a certain kind of macro discipline.
So you and Tom are basically saying the same thing. Yields up, equities under pressure, which either means you've both spotted the real tape, or we're about to get humbled by whatever the Dallas Fed throws at us this morning. My call is NVDA closes today in the green, up at least 0.5% from yesterday's close. I know the QQQs are flat and tech's been dodgy, but NVIDIA's holding a bid in pre-market while the rest of the mega-cap complex rolls over, and I think that's telling you something about fund positioning into the FOMC. I'm wrong if NVIDIA closes red. That's it for today, 3 Clowns, episode 16. We'll be back tomorrow with the scorecard. Thanks for listening.